something last?
The cold open.
Yeah, I mean, we could do the cold open, or we could just bring in the clip. I mean, whatever it is, we'll roll with it. And if we're gonna do the clip, then obviously we'll just trim out the beginning.
Let's do the cold open. Sam, what was your biggest mistake so far at 2025?
It's actually
Fucking starting a podcast with you guys, dude. That's like it's the worst mistake. My already busy life has gotten seriously busier. That's the worst mistake of this year.
We're the escapism, Sam. Don't you dare. We're not the accelerators of your life stress.
It's the worst mistake of my life. I don't know why I did this, but here I am, But the worst mistake,
not blowing up, just
I mean, to be honest, it's like buying the dip, not buying the dip as aggressive and quickly as I did, and like getting caught in the noise, dude. I was like knee deep in that freaking noise like the last week, and I bought the dip hard, but I didn't do it on the day when I should have done it. And look, in hindsight, everything is obvious, but like when that cold CPI report came out, that was it. That was it, in my opinion.
Well, we should talk to Mr. 20% in 3 weeks. Logical,
Yeah.
like he nailed 2025 so far. So we got to talk his playbook a bit.
Crazy.
Yeah.
It took me way too long to figure out where to point just then.
We're all worked around, but yeah, been a crazy start to this year for sure. I don't know.
I mean, when you're up 20% in 3 weeks, like does that dictate your behavior the rest of the year? Because I feel like my quota is always 15%. I know the last 2 years I've succeeded that substantially, but my expectation is always 15%, and you're already at that 3 weeks in.
Yeah, I think I was expecting a 10% year, honestly, and I'm at 20% on January 23, so that's pretty nuts. Does it change my perspective? Here's the thing, right? You aim for 15%, but I don't think you aim for 15% on any given year. You aim for 15% over a long time frame, and that's going to include all the drawdowns and whatnot. So actually, you have to milk the big years so that you can afford being down on the bad years. And so, actually, I was saying, hey, I want to take down some risk. I do want to take down some volatility. I took off a lot of my calls and I'm sitting in shares. But the more I think about it, I mean, dude, we just closed at an all-time high today. Did you see that close today on SPY? I mean, it was just straight.
We closed at all-time high. I had no idea.
All-time high, baby.
We had an intraday. We had an intraday all-time high yesterday. We did not close at an all-time high, but today we officially closed at an all-time high on SPY or SPX. And yeah.
I was gonna say how much has changed since the last time we recorded this, which was last Thursday. I was literally talking about SPY kind of looks a little bit weak, and I was saying I have some SPY hedges on. But when we gapped up on that Friday morning, and I was just like looking at the weekly, and again, it's during the day on Friday. It was a bullish engulfing, and I was like, okay, time to cut my bias. We're no longer going down.
That was when I just like pretty much depleted my cash when that happened.
Yeah, which is great.
And I did it a bit on Thursday, but like after that, I was like, okay, I'm gonna deplete my cash right now. That was when like I kind of got in some crazy speculative stuff, but like nothing too crazy, not like 2024. I don't see, this is a problem, is that like we're kind of coming to this year the same way we went to 2023, but not exactly 100%. But 2024. But I remember in 2024, people were expecting some sort of weakness coming to the year because the market just rallied like 20% since the 10% correction bottomed in October, right? And all up until the end of the year, people are like, we're not going to get the sand cause rally. We already did this. And the market, remember, it had really bad first 5 trading days of the year in 2024. And people thought this was the top for now, right? And then look what happened for the rest of the year. Like it could happen again. Like, I'm not saying it will, but I'm saying like that could happen again because I feel like we're kind of setting up for it.
I put out a poll.
Let me ask. I do.
I was gonna say I put out a poll back on December 18th or 2 days after December 18th when we had the FOMC, and I was like, will we see new all-time high December, the same month, January, February, or March or beyond? And 29% of the people actually said January. I was actually shocked. It was the second highest. Most people were still saying December.
I didn't think so.
And then January was second, and then March or beyond was like all the bears down there. I was surprised. I revisited that today because I was like, hey, we hit it.
Well,
price action changes day to day.
I think,
right?
Yeah,
that's the thing. And also,
sentiment is like this right now.
Yeah, it really is.
We're
If you
also
look at
we're also getting more. No, I was gonna say we're getting more details about Stargate, and it looks like it's not as substantial as a lot of people anticipated. It looks like a repackaging of Air, not really
we definitely
anything.
got to talk about that. We definitely got to talk
So,
about that.
but do you think this rally is more associated with the semiconductors running hard the past week when they were absent towards the end of last year, and obviously they're a major component of the indices, so they're going to take the indices with it. But what if there's actually no real dollars associated to that 500 billion Stargate initiative? Do you think that's why we're bouncing, or is it more of the dollars weakening and 10-year yields kind of reverting back to 4.5%?
Well, I don't really know how to explain this, but a lot of the market is really driven by sentiment and positioning, right? So if sentiment is pretty bad, but everyone is long, which can happen, then the market's not really going to blast through all times high like it did. But sentiment got bad and the positioning was offsides. A lot of people were set short, or a lot of people were selling their stuff, right? And there's even the COT or commitment of traders future positioning did show that. And it's not 100% accurate, but it did show the dramatic difference between last week's as well as weeks prior, right before the FOMC had their December meeting. Everyone was like totally bullish long before that, even positioning wise. And then everyone got short pretty much currencies across the board and stocks for the most part. Not short completely, but like as far as the indexing level from where they are, like they definitely reduced their positioning size. And so did the NAIM, which is the exposure index for all of the major hedge funds. We were bearish. I think I said this last week, like we were bearish as well. Like it's just, you flip that around with one catalyst, game on. Everyone comes rushing back.
Well,
I
you
think
saw
it's
the
that-
RSP, right? The equal weight. The equal weight was getting
Yeah, the
absolutely
equal weight,
destroyed
yeah.
at the end of December
Yeah.
and early January. And then if you look at it now, it flew back. I mean, it was basically outpacing SPY at first. And yesterday it had a slight pullback in it, but today pushed higher. So like
Dude,
there's
Dow,
breadth in there.
The Dow Industrials had the worst losing streak since the 1970s. That's a long time to go back. Yeah, that's what Steve from All Star Charge was saying. Yeah, it was a freaking rubber band, and now it did its 50% retrace, and now we're back at the point where it's like, what the hell is going to happen with the market? So, like, who the hell knows, dude? What do you think, Logical?
I think it does come down to positioning, but I mean, we had reasons to be a little bit short-term bearish. I don't think any of us were long-term bearish. We did see those distribution days on the NASDAQ. It did look a little scary for the near term, but yeah, I mean, you just have to close out your bias and look. I mean, we still had a 2.9% CPI reading. The question just then becomes like, is this, maybe market is telling you that it's not as bad as we thought. Maybe we start trending down in CPI. Maybe that means that we can get some relief in bonds. And I think also we had a follow-up week this week with the Trump inauguration, and it was Druckenmiller's comments saying basically, business leaders on the ground right now are feeling giddy about what's to come. And I think when we talk about that Stargate stuff, it's not so much about that one specific project. It's more like the idea that Trump is very aggressive to get U.S. business going, U.S. economy going. He's committed to that kind of stuff. So it's not necessarily about the one single project. It's more about like, let's go do this. We're willing to put money into it. We're willing to like get other countries involved. Let's invest in America. So I think, and then he was talking about tax rates. He's talking about better relations with China. I mean, let's bring down the price of oil. Let's just go. So I think, I mean, who wouldn't be giddy? And I think ultimately, the bull cycle is definitely speeding up, picking up. So.
No, I mean, you nailed it. Where it's funny how like the Trump buckets 4 years ago, I feel like the Trump buckets were like defense, oil, etc., like those kinds of themes. That's not the Trump buckets anymore. The Trump buckets are a lot of the early secular growth themes: AI, quantum, space, nuclear. Like these are the themes.
Cutting edge.
They're cutting edge because he's labeling Stargate, the initiative, as American AI. He wants the U.S. to have the best supercomputers in the world. So he's going to do some quantum infrastructure announcement probably sometime this year. He wants U.S. to have a massive presence in space economy There's going to be some kind of space infrastructure initiative. I mentioned this on our Wednesday space that we have, where think about all the areas that Elon has exposure in, like the first buddy, Elon Musk, SpaceX, Starlink, two of his major companies are in one industry. Do you not think there's going to be a stupid amount of flow going towards space economy infrastructure during a Trump-led presidency? There's going to be. And that's where you're seeing Rocket Lab, the space logistics company of the future, the FedEx of space, just continue to catch a bid in 2025 because it's a multi-trillion-dollar space economy in 15 years. Yes, 15 years away. However, the FedEx of space right now is only worth $14 billion, and they're about to be profitable in 2 years, and they have a 50+% CAGR for the next couple of years. So, like, it's just it's weird. Those future-looking themes isn't so future-looking in a Trump-led presidency. It's kind of a near-term reality. I think it's almost like an accelerator, like how COVID accelerated e-commerce years. It's inevitable. E-commerce was the future, but COVID accelerated the process towards there. I do think Trump being president is going to accelerate a lot of the AI and quantum space themes.
I agree, man. I agree. Before we continue and officially kick it off, which is not so we already officially kick it off, but want to hand it over to Amp to do the ad call out, give us some solid introductions. Let's go, Amp.
All right. Welcome back. Episode 2, Investing with the Boys. Boys, how are we doing tonight? Good to see all of you again. I'm excited for this episode. Do want to shout out our sponsor, Osprey Funds. We appreciate them sponsoring this show. Check them out at ospreyfunds.io. And I'm just ready to jump right into this. So I'm going to throw it over to you guys and see what you guys have for us tonight.
All right, real quick. I just saw something on the news right now. Trump prefers to avoid imposing tariffs on China. That's very interesting.
He just said 10% 2 days ago.
Yeah. Well, he changes his mind very quickly, doesn't he?
Dude, what kind of dreams does he have to wake up changing his mind? Jeez.
Hey, man, I just turned KWeb to my second largest position. So please, brother, let him pump my bags. All right.
Is KWeb running right now?
I don't know. Good question. I don't know about overnight trading, but what I will say is, look, I think that everybody knows I'm going to just jump in on China since I saw that data point, but real quick, KWeb, man, look, it looks like everyone knows really what's going on in China. Obviously the economy hasn't been great. Those things are known, right? And the stock is still kind of holding up well. KWeb, for those that don't know, is China Tech ETF. Think of it as QQQ. I mean, I'm just looking at it from a technical basis. If it was to break technical pattern, I would probably say, look, hey, this is kind of a trade for me. I have my stop in place. I want to get out. But for now, it's kind of holding that bottom of the channel. Technically, it's kind of shaping up really nicely. And I don't know, for some reason, I just felt like Trump is very pro-China. I actually just added to that position today. And so I guess it's up 1% overnight. Thanks, Amp. And so...
Actually,
is it more?
Well, no, I'm looking at the index though. HSI is up 1.31%, and HS Tech, which is what KWeb is mostly based off of, it's the QQQ index for China for Hong Kong, 1.85%. So that thing is pumping.
Well,
China.
Yeah. Here's the problem, right? Like we had some news about some policy last night in their big meeting or whatever. They have these once in a while about insurance companies have to buy some shares in Chinese companies, blah, blah, blah. The stock was up and then it, reversed all of the China market. So, these things are fickle. So they go back and forth. I wouldn't really look at an overnight pump as anything specific. But anyways, point is just being, in terms of getting ex-US exposure, I felt like it made sense to reduce my US equity. And then looking forward, Trump just seems like he's a little bit more pro-China, trying to save TikTok. I don't know. The vibes were kind of there and the charts look good. So for me, it's a trade, but yeah.
TikTok is up, right? Because it was down for like a day. And then
yeah, it's up. It's back up.
Yeah, it's pretty much been back up for quite some time. I mean, we knew that was going to happen.
Things are too rosy right now. I think there's going to be, it's going to be back and forth. Like, I know like everything's like, so like we're all best friends in this world. Let's just push forward humanity towards tackling this technical revolution. That's not going to be how it's going to go. There's going to be some rug pulling. This is going to be back and forth. So I don't know. It feels, you have to know, like in a Trump, I love I love how pro business Trump is, but a lot of it is a show. That whole thing is reality TV, like
100%.
the politicians.
This
So
isn't reality TV. This is Comedy Central.
it's it's just fake. It's all fake essentially. So like take it with a
This is
grain of
entertainment.
salt.
Yeah.
My thing about KWeb is like, again, like that's why this is such a great pod, because we're all such different investors. Where Logical is a lot more with the catalyst trait associated with his investing style. Sam likes a little geopolitical spice on his investments. For me, I can't invest in something that if it dips, I don't have the conviction to add more in. So if KWeb, if I'm wrong and there's a stop loss at 2850 or 2870 and it hits that, I don't like stop losses. So like if it goes down 10%, let's just say hypothetically, I don't really know what to do on position because I don't have that conviction in that name. And that's why it's like so hard for me to be a catalyst trader. But I envy you two because you guys both have that trait in your investing arsenal. Like, and I wish I did, because I do think I would get more alpha in the near term, but a lot of my investing styles 5+ years out, because I don't have that in me, that catalyst dog in me.
I think it's not even. Sorry, go ahead, Sam.
I was going to say, because I think Logical and I, a large portion of our portfolio is long term.
Yeah.
For me, about 80% of my portfolio is long term, and I think Logical is somewhere around there too. The thing for me is that 80% of my portfolio is long term, and 20% is more short term, which is where these, as Logical would say, cyclical trades are, where it's more of a short to medium term for myself. And that's usually when I start using options or some sort of derivative as part of getting long something. I personally would not invest in China for the long term, mostly because a lot of the data that come in, like, we don't know if it's true, and say that because I'm being I'm being biased since I live in the United States of Trump America, but I mean, we don't know what the data is coming from China. China is a socialist economy. There is a certain type of hold that President Xi Jinping has over his entire corporate companies and private companies, quote unquote private companies. And we saw it with Jack Ma. The dude disappeared once he started making outlandish remarks about the Chinese government. And he's been back, but is he really back? I don't know. Is that him? Who knows? But it's those kind of things. And in addition to the fact that the US is the number one technology sector in the entire world, and where most of the money rotates into, this is pretty much where you're going to find your alpha. That's not to say that other places don't present opportunities. So I don't know. I mean, that's just my take. What do you think, Logical?
Look, I just want to make something clear. Obviously, based on the environment we're in, and I think you asked me a question early on, Shai, like, does it change how I feel based on I'm up 20% year to date? Does that make me want to think a certain way? What I will say is that, like, last week, I took off all my options and I swapped to shares for my entire portfolio. I just feel like, Trump presidency, this guy can tweet something, everything volatile. Volatility is going to be high. I don't want to have a heart attack every other day. So I figured shares make a lot more sense. That said, I think that, from what we're seeing, right, like we had the bullish engulfing last week. We had an all-time high today. Clearly, everything looks like it's ready to run. He comes out today. Trump says, we're going to get interest rates down immediately. I mean, this stuff is crazy bullish, right? And the market, the price action, it's showing you that it is. So, you would think that I'm going to get more conservative, but actually I've been getting a little bit more aggressive with my trades. I'm still not like slamming calls and whatnot, but I'm definitely longer in shares, but I'm taking a lot more trades right now because the trades are working in this environment. And I would say that actually, so originally, I think we've all talked about this, right? You have a 20% year, another 20% year. Usually you're expecting kind of 5-10% year on the third year. We are not off to that. We are already in 5%. Now, do we melt up and then fall down, end at 5-10%? Maybe. But for the time being, we're melting up. And so the timeline of the bull market just kind of got moved up. And, a lot of data will show you that half of the bull market gains will come in the last 1/3 of the bull market. If it turns out this is the last year of the bull market, then you should expect a very big year. And so the way I think about it is 2023 was the year of Mag 7. That's kind of like the easy low-hanging fruit. Then it became the popular growth stocks in 2024. Those became overvalued. Mag 7 fully valued. Now it's kind of everything else in the market that's catching a bid. What happens when everything else in the market catches a bid and everything is fully valued. Where is the value in the market then? That's where I think we're headed already, is like a lot of these stocks that I've been following. That's why I feel like this year I've been doing so well, is because it's kind of where I focus, is like off the beaten path, not the Mag 7. I don't own those things except Amazon. I don't own the popular growth stocks. Everything that I own is kind of catching a bid this year. So it's making me think. And again, I think that's kind of why I push back on a lot of bears for the last year or two, talking about, oh, the S&P is at a historically high PE or whatever compared to its average. And it's like, well, that's kind of a lazy argument, because you're not looking at all the different constituents in the stock market. And I felt that there's a ton of value, which is why I've been slamming calls, been long margin. So I think right now what we're seeing is, and I'll finish this thought, what we're seeing is a lot of things are catching bids, and a lot of things that I focus on that I do believe have value. And that's happening a lot faster than I thought. So I am trying to build a bit of an exit plan of like, hey, look, if we keep running like this, fantastic. Too early to be in cash, but at some point I will be raising cash aggressively. I'll end it there.
Let me Sam Logic, let me ask you this question, because I think every person will have a different answer. We're all long-term investors. My time horizon is 5+ years on my holdings. What is your time horizon on all your 80% of your portfolio on your long-term investments?
I'll let you go first, Sam.
For me, I would say probably 50 to 60% for the 80%. No, actually, no. It'll be 60 to 70% is I'm just holding, right? Like, I think half of my, a little bit less than half of my 80% is just in indexes, right? So besides that, I haven't sold a single bit. I have a good amount of Amazon, but I've actually increased the alpha with my Amazon by rotating between leaps and shares. As price continues to move forward a lot, I tend to trim back into shares, and then so I want to keep doing that, and it actually increases the return. But as far as like specific companies that I'm looking at, I think I've just been in the same companies, whether I'm rotating between shares or leaps, probably for over a year now. And I don't plan on changing that. Like, once I find leaders that I want to continue investing in, especially when it comes to like Amazon or even Nubank, it takes a lot for me to change my mind about it. Like, I'd have to see like continuous bad quarters and like whatever. But besides that, like, I'm not ever planning on selling these companies like completely. Maybe I might trim it, maybe I might add to it, but I'm never like going to sell out of it completely.
So like Astera Labs, you just initiate a position on that. Like, do you have a time horizon on Astera Labs? Is it just until this is broken? Doesn't matter how long it's going to be, or do you like, or the reason I'm getting, like, what I'm getting to is like space and quantum. You guys neither have any exposure in that. So like,
I do.
What?
Quantum computing is Amazon and Google, dude.
Oh, I meant pure. I meant pure play.
Pure? Do I have IonQ? No, honestly, I might have missed the boat on it. If I'm going to do it, I have to DCA in it. I did buy some Rocket Lab, probably at the worst timing, but I figure, if I want some exposure, I'll just have like a small position in it and just like DCA a little bit into it, but nothing like, I wasn't, here's the embarrassing part was that I had like 400 shares of Rocket Lab when it was like $4. And I wanted to take the money to invest in other stuff. So I did. And, I bought back, not close to as many shares, but, just a small position when it was like 10 times higher. Right. So it happens, I'm not too concerned about it, but, just having like a small size in something rather than making something a big size, as you've been accumulating over time with Rocket Lab, average under $5, it's too late for that, in my opinion. For me, it's too late for that. But then there are certain companies where I have no problem making a big position, even after an explosive move. I guess in a certain aspect, if you think of Amazon, like, if I was really strapped for cash and Amazon was trading if I was not strapped for cash, if I had a lot of cash and the market was down 10%, Amazon would probably be around $200, unless like something really changed, whatever. And we saw it. The market was down 5.something%, and Amazon was only like 2 or 3% away from its all-time highs. And I bought more Amazon.
It's because every portfolio has a couple anchor stocks. Like, it's just like, it will always be a fat position.
Core positions.
Exactly.
I really never sell out of my core positions.
I call it the bonsai for me. For my portfolio, it's like the bonsai portion where I always like, I add a little, make sure it's like a good chunk of my portfolio. Like, I have 20 names, top 5 names are 50% of my portfolio. Like, I ride or die on those 5 names. But Logic, I want to hear your thoughts on your portfolio management style as well.
Yeah, I'll say that over the last year, look, man, we are learning every day and we're managing this stuff in real time. And I would say I've changed my perspective a ton. I know I talk about buy and hold, but I'm starting to realize that, man, I don't know if I have it in me to hold the stock for 5-10 years. I really don't. I think a swing trade makes sense to me up to like 2 years at a time or something like that. And then I'll reevaluate. Like, I mean, look what happened to us on Transmedics, man. I was holding that thing and I was like,
It's not over yet. It's not over yet. We'll see.
sure,
It's just,
sure. But like, I think we should constantly evaluate the holdings in our portfolio
Yeah.
and determine like I was so like confident in this business, almost arrogantly so, to think like, hey, 176, I'm gonna just hold this stock. Now we're sitting at 60, right? Like, so I think that you want to constantly verify, validate, determine if there's better uses of the capital. I mean, we're sitting here in a bull market. It's a great bull market stock, but once it starts losing its technicals, I mean, you got to really start thinking ahead of like, look, volume's coming in, it's selling this thing. And so I use technicals a lot more in my process now. And I was saying earlier, right? Like, again, if we get a very big melt up year, I will be looking to basically offload a lot of my portfolio this year because I won't find a lot of opportunities as I've seen for the last year or two. So while I say I'm 80% buy and hold and 20% swing trading, I'm actually becoming different now. Like I'm willing to go to literally 100% cash if I need to, because if I feel that things get absolutely silly, I'm managing money for myself, my wife, and I want to be able to do things with that money. And so if I think that and maybe taxes will suck, but you don't make investing decisions based off cash, I want to continue to evaluate what are the opportunities, what are the backdrops. Right now, we look like we're in a melt up. But over time, I want to start selling into strength if we continue to melt up in this way into an unsustainable level. So right now is not the time for cash, but it might be soon.
See, this is where I have to be honest with myself, and whether you guys believe me or not, it's cool, but I know myself enough that if I were to get into somewhere more than 15% cash, which is a lot for me, it's very hard for me to get a 50% cash without feeling some sort of FOMO, whichever direction the market's going to go in. And personally, I think that over time, the market is literally built to go up over time. We already had 2 bear markets in the last 5 years. Maybe we didn't have so many 10% corrections, but I don't think, and I know you've said this, I don't think we're setting up for like a massive drop or maybe a retrace of whatever huge melt up situation we might have this year. That's why it'll be so hard for me to get more than like 10% cash, if anything. What do you think, Shai? Like, do you think that there's going to be a massive melt up this year? And if it does, do you think that whatever happened, let's say we're up to S&P 7,000, right? In the next few months, do you think that there's a very high likelihood that we might retrace back to 600 in a short period of time? That would be a bear market.
Live or die on how quickly AI can hit that certain stage in their maturity. I think AI is going to be a massive deflationary environment when it hits agentic AI specifically. When it actually like hits a couple years into that, it's going to be so deflationary that I think the inflation at 2.9% we're talking about right now, I wouldn't be surprised if you start seeing negative prints. Like it's going to be a real 180 change, and also it's going to be massive margin expansion opportunity for a lot of these enterprises. So it's going to be like an earnings expansion story and a lot of like, it depends on the timing of where AI is, but also like, I'm not good at macro. Like this is like, I'll revert back to my portfolio management style as well, because this will make sense on why like your question is so hard for me to answer, because I'm not good at timing the markets. I'm not good at the macro front. Like I view it as a tool to have in my back pocket, just so I know like what's happening, but it doesn't guide me towards my decision making at all. Where I'm a thematic investor. I identify themes that will go through structural shifts that are going to affect so many different industries over the course of the next decade. That's my edge. Like that's my lane. I can identify what's going to happen there, and then from there, I can identify through my research who are going to be the winners of each of those themes, based on their moats, fundamentals, whatever the scalability of their product is, sticky ecosystem that takes years to migrate out of, Snowflake, a logistics network, TMDX. So it's just going to be a lot of like those kind of moat characteristics matter a lot underneath these themes. And then I just build a position and I do it at my own pace, whatever the market does. So like, that's why for me, it's like, I hate having a big cash position. I'm fortunate enough to be in a position in my life where I can infuse 2 cash every single month in my portfolio. So like I know like if I just like have a 10% cash position, if I don't do anything for like 2 or 3 months in a melt up mode, it's going to build up to 16%. Then after that, 18, 20, like I would be worried on like, I'm building a fat cash position. So like usually right now I have a 6% cash position. I think that's a sweet spot, to be honest. Like it gives you enough to add to your high conviction names if there is somewhat of a slip up in their earnings. Because as we know, we're all growth investors. Algo driven sell offs can occur in the blink of an eye that causes a 15 to 20% drawdown in a stock that nothing changed on the thesis. Just a light near-term guide, or ARR was slightly light that management's going to make commentary on the conference call and like, oh, that makes sense. Like you have to have the dry powder ready. So like, but that is like, that's my portfolio management style. However, it's burned me in the past because it's a romance I have my holdings. Like it really is. Like I do the time research. I know the company inside and out, product management. I feel so attached to them because like I'm willing for them to get in my heart essentially. Like I believe in you guys. So like don't disappoint me. And it burns me because of that. I get emotionally attached a bit. And you saw with TMDX where I luckily like it's not like it wasn't never a 12 or 15% position. Like when I was at 170, I think at the most it was an 8% position for me, maybe like 9. But even then on the drawdown, like I wasn't as aggressive as I would be for like any other company within software growth tech, because listen, a medical device company, like it's outside my lane. It really is. Like I understand the thesis of the company, their fundamentals and their mo, but really like I don't really understand the nuances like of the medical device company as much as I want to. Like that's on my edge. Like I wasn't as aggressive on the dips because it's not my cup of tea. But Unity is another great example. I freaking love Unity's technology, their product. I'm obsessed with it. It burned me the past 2 or 3 years, and it didn't let me add Unity goggles that prevented me from seeing AppLovin for what it was 2 years ago. And that's something that I'm learning as a trader.
You're not the only one who missed AppLovin. The whole market missed AppLovin, and that's the reason why I went up 300% in a matter of a few months. Like you're not the only one who missed that one.
Well, dude, it's $150 billion company now. It's crazy.
I know that's what makes the setup is because no one sees it coming or no one expects it coming. So the short squeeze gets massive. But to be honest, AppLovin, its fundamentals like totally justify.
Well, let me see what their fundamentals
maybe not
are
today.
now.
Not today, but like, dude,
No,
like
well,
that.
Yeah,
Yeah,
I looked at that one at $80 and I saw, I was like, wait a minute, this trades at like 20 times free cash flow. And then I'm looking and the analyst estimates on like Yahoo Finance were like, oh, they're only going to grow like 10, 15% next year. That's probably why it's so cheap. And all of a sudden that analysts are, good sometimes, but not always. So,
well, I will say this though. Like, listen, like AppLovin, it has Adobe like cash flow at such a like out of nowhere. All of a sudden, like it went from 13% free cash flow margins in 2022. Now they're putting 45% free cash flow margins while growing the top line 20% CAGR for next 3 years. That's freaking wild. Yeah. However, they have a duopoly. They have a monopoly in what they do. They won't maintain that monopoly. They won't. Unity is going to create a product that's very similar, and they are already in path for that. And we'll see what happens to the margins from there. But either way, like AppLovin, I know we have a couple people who like are bulls on that. Like that caught me way off guard, and that's something that's in my lane specifically. And I just like that Unity goggles freaking messed with my vision on finding a massive monster in the making in AppLovin, and that's something also like ads are going to grow at a insane pace in the next couple of years, next decade, insane. That's right. Trade Desk is like stupid premium valuation and won't go. It's not dipping. It's just maintaining because ads are going to, AI agents are going to create a stupid amount of products going forward. What do you have to do with that product? You have to advertise for it. You need these like AppLovins, Trade Desk, outside the wall gardens to do that. So my question for you now, like actually, I want to ask you Logical this question. Yes, Magnite. Because I do think Adtech is one of those industries that will consolidate. They will. It's one of those things where it's partnerships kind of is what like outside of Trade Desk, like Magnite, PubMatic. It's really partnerships a bit on the sell side. And I feel like Trade Desk can easily go on the sell side. They really can. I don't see like how it would be that difficult for them. So like where is are the smaller players able to survive in this post-agentic AI world for the Adtech side of the business?
Well, I would say one, they have right now 2 large partnerships with Netflix and Disney. Actually, I think when the stock sold off a few months ago was because a Disney exec went on a podcast and said, "Oh, we're working less with the Magnite," and so stock sells off. A month later, 2-year partnership extension signed, so stock rebounds. You see the connected TV numbers that they're reporting are really good, and that's before the Netflix partnership really takes off in 2025. So that was actually from a few months ago. So they're dominant on the SSP side, the supply side, where they're representing publishers in the CTV category. So obviously, we all know what Netflix is doing. They just reported earnings. They gapped up like 10, 15% after they did. And a lot of that was due to growth in their ad tier. So we know that's driving a lot of international growth. And so again, if Magnite is the one that's helping them facilitate those ad transactions, then right now they're kind of safe. But of course, it's a small cap company. They lose a big partnership like that, market will dump this thing. So sorry, go on.
No, let me ask you this. So, like, I think here's my biggest thing about smaller players, like trying to tackle the bigger players. Like, if they're not outgrowing the bigger players and they have lower margins than the bigger players, do they actually have some kind of advantage? That's the value trap in my head. Like Magnite, they're growing 10% for the next couple of years, where Trade Desk has a 28% CAGR and they have triple the amount of margins that Magnite has. So I'm like, that's my difficulty. I'm like trying to, I know Magnite looks very undervalued. I agree with you there. It's just, they should be growing much more than what they are right now at 10%.
So that's 10% total revenue, but their CTV revenue is at 25% or something like that. So, that's where I'm
is that much
focusing
higher
on.
margin?
Yeah, that's the problem will be that their take rates are kind of lower when they're working with someone like a Netflix because they're getting such high volumes. So we really haven't seen the amount of revenue growth they're going to get because that volume is going to be insane, like nothing this company's seen before. And so, it's a little weird to be long Magnite, right? Because you can't be too long because it's obviously they lose a partnership like that. Yeah, stock gets killed. But for now, I mean, they're just starting, so we haven't really seen the extent of that. And yeah, I mean, you get Netflix coming out and basically saying, "Oh, our ad stack, we've been building it, blah, blah, blah." And what you hear actually behind closed doors, it's actually Magnite building the ad stacks for these companies. And in terms of being disrupted by like the Trade Desk, I mean, this argument about OpenPath, which they have for publishers and, helping publishers and whatever, it's very overblown in my view. They've been saying this for years. I think the only publishers that can actually implement something like OpenPath is going to be the ones that have a whole in-house team. You got to be really big publishers so that they have their own yield management tools. The Trade Desk has come out several times and said, we're not going to be doing yield management for them because then they're playing two sides of the transaction, which gets a little bit of a conflict of interest in my view. So while they're helping to facilitate their buyers' demand to, legitimate publishers through OpenPath, they don't want to be necessarily representing the publisher in that way. So they still want to keep the publisher on the other side, from what I understand. So it hasn't really made a big dent. I mean, companies like PubMatic and Magnite are still growing. I've lately sided with Magnite just because they have that connected TV advantage. I mean, we'll see what the volumes look like. Ultimately, you can't size a position like this too big because they're at the whims of some of these larger contracts.
This is probably.
I didn't know about the CTV at 25%.
Yeah.
No, go on,
That's
Sam.
a big part of the thesis for sure.
This is probably the type of company where it's like, I should probably look into this because even though it's had quite a run in some time, this would be like a small cap type of company. It doesn't sound like it's like in the speck of the bucket either, but sounds like they got some pretty good fundamentals of things going on. If it's a high margin business, that's definitely in my radar. Like if you look across all my portfolio holdings, like they're usually, the reason why they're mostly centric around software is because of the margins. Like I need to have a high margin business somewhere in like at least 50% margin is like the lowest that I'll go. Right. So
it's because of scalability. That's why that's the part of the most.
That's why I love software so much because of the fact that, when you have something like Snowflake, Snowflake's a bad example. You take something like GitLab right now, right? They have very high margins. Like it's north. I think it's like around 80%. I forget the exact number, but they are not profitable yet. So it kind of scares a lot of people from getting with a company like that. And I'm sorry to switch the topic from ad, but it kind of has to do with like my whole investment thesis is that the margins got to be high and it has to have a lot of room for margin expansion. And I'm not looking for something that's like a sure bet with a lot of margin of safety. You know, like if I were to look at Magnite and I would love the fundamentals, I would probably start DCAing into it right now. That's just my style. And I wouldn't mind holding it for a long period of time, especially the small cap. It's probably something that could easily do like a 10 or 20 times in the next few years. I'm not saying it will. I haven't done that much research on it at all, but I'm just saying like, if it was a small cap opportunity, I wouldn't need a big position in order to make a big difference in my portfolio. So even like a 1 or 2% position would suffice if it did like a 5 or 10 times, because then it'll become very big at that point. But you know, that's something interesting. If you could tell me if Magnite has very good margins for its fastest growing sector, then holy crap, that might be a good potential.
Let me just real quick, just close the loop here on Magnite. 23% year-over-year growth in CTV. That was for the Q3 report. So we're still waiting on the Q4 report. But again, Q4 for advertising industry is the highest because you have things like Black Friday, Cyber Monday, you have the holidays. So we should expect a big Q4. That's where a lot of these companies make their
win for
margin.
Amazon. Yeah.
Oh, yeah, exactly. Of course. And sorry, last thing, raising free cash flow growth to approximately 20% for 2024. So again, this is a business that, you know, is not trading at that expensive a multiple. Sorry, go on, Shay.
I was gonna say 2 years ago, it was growing at 31% free cash flow margins. And that was their margins. Like there is somewhat of like, I'm looking at their, like that's what 2022, they had 34% gross free cash flow margins.
For what quarter? For the whole year?
For whole year. And then 2023, they had 34. They had 31% 2022, 34% 2023, 20% this year. Now it's going to go back to 25% next year, and then 2026 it's going to be 17%. So it looks like it's weird. It's like very wonky. It might be due to the product mix on their CTV, and I don't know what that's all about. But also, like their margins are only 53% 2 years ago. It was 34% gross margins last year. And this year is 63%, and then next year it's 62%. Like, it feels weird what's happening right now.
Let me tell you something about like a name like this in the ad industry. You have to know that, I'm sure you do know because you follow the trade desk, but like it's a very cyclical industry, right? You want to buy when things look bad.
Yeah, it is definitely cyclical.
So you want to buy when things are bad, when their margins are down because their revenue's down. So we actually had an ad recession, between 2022 to Q3 of 2023. That's exactly when I was listening to the call, the earnings call.
That was when I was buying TTD, man.
Yeah, and I heard that. Yeah, the management team was basically saying we just saw a bottom in CPMs, and I was like, okay, it's finally time. You know, this is the bottom of like what they're going to earn. So their worst quarters, that's when these stocks actually start gapping up because people start calling bottoms on them, and you know, stocks up over 100% in the last 14 months. And so, you know, you want to be long these things for a cycle. They're cyclicals. And you want to buy when the margins look bad, when the numbers look bad, and you want to sell when numbers look good. So I think a year from now is exactly like, you know, maybe this year, even once we start seeing those Netflix numbers, you might want to be out of this name. So lumpiness is expected in this industry. What I will say though, one last topic on this, because you guys talk about small caps. Look, I live and breathe small caps. Look, you're not gonna get a trade desk. You're not gonna get a trade desk here. You're not gonna get a Snowflake here. You're not gonna get a moat. You're not gonna get defensible stuff. We're not talking about like the most amazing businesses in the world. There's a reason why they trade at cheap valuations. For me, I am very valuation and numbers focused, so I can get very comfortable owning. It doesn't need to have a huge moat. You know, you guys are cool with like owning something that, you know, Asteria Labs or whatever, that are super expensive stock, but has an extreme moat and is going to have like all these great growth themes, and the stock's probably never going to get cheap. And so you guys are, you know, feeling very comfortable riding those things. For me, I personally can't. And I'd rather have something that's a little bit less growth, maybe inflecting growth, but has like something that I feel is a margin of safety in terms of the valuation. But you know, you guys feel that you have a margin of safety from the quality. It's just kind of a different perspective and approach to investing.
You nailed it. That's the line right there. Margin of safety because of quality. I love that line. That's exactly what it is.
Don't get me wrong. You got to kind of see this is the way that I do it, right? I do a slow DCA when price is in an expensive valuation. And then when it pulls back, I know what I want to buy. Like, for example, TTD, right? I thought I missed that damn shit when that thing was like trading near 100 like 2 years ago, right? So middle to end of 2023, right? The thing was trading like 100 something. And then they had this crazy quarter where their margins
It was
contracted.
two
Yeah.
quarters ago, I think. Yeah, it was
Yeah.
Jeff Green's first
No,
ever
it was
miss. I
more
think.
than that. It was more than that. But yeah, no, it was one of the first misses of TTD, and the
Yeah.
thing dropped like 30-40% overnight.
Mhm.
And I was buying that hard with calls and everything because it was like, this made no sense. This is the leader in its industry. It's got both sides of the, well, actually, in one demand side, but they pretty much own the entire platform. They have a wide moat, like they already have their customers and everything, and they already have their clients using their products. It would take, and on top of that, they were announcing buybacks, and it was like, this makes no freaking sense why this thing sold off this much. That's when I jump in hard. Right now, I'm not exactly jumping in hard in Astera Labs, right? Like, yeah, they got the deal with Amazon, but that valuation, I think the market already figured it out. So there's a pretty good chance that I'm not going to say I'm going to lose my money, but there's a pretty good chance that it already had its massive run unless there's more surprises in the market, right? But if that pulls back considerably and nothing really changed, except for a few numbers or a bad quarter and so on, whatever management says in the conference call, and not to say exactly with A-Lab, but like in general, then that might be the opportunity to load up. And when I say load up, I'm not like load up with calls and something. I'm saying like, like full size position that's specced out before it even falls in the first place.
So Rule 40 score, you guys both hear me talk about it all the time. It's my favorite metric to quantify a company's moat, because anyone can grow the top line and lose a ton of money. Anyone can print cash and not grow on the top line. Very difficult to do both. Like growing top line 20% and having 20% free cash flow margins. Very difficult. So if a company has a Rule 40 score or 40 of above, they have somewhat of a competitive advantage or a moat that allows them to have pricing power while also growing. So that's why Trade Desk is a very easy one to see. Like, just looking at the fundamentals, they've always had a 55 or higher on the Rule 40 score. Always. That's showing they have a significant moat, and it's going to continue to last. Astera Labs is one of the wildest Rule 40 scores I've ever seen. Ever. Where they're supposed to be growing this year in 2025 61% while having 27% free cash flow margins. Let's just say a 4-year CAGR for the next 4 years. 45% CAGR on the top line for the next 4 years with a terminal 40% free cash flow margin at the end of that 3 or 4 years. That's an 80. That's wild.
That's adjusted, right?
No, it's free cash flow margins. No, I'm not talking EBITDA.
It's probably not ex SBC though.
Obviously.
Yeah,
No, it's obviously, yeah, it's not SBC related.
This
okay,
fine,
we can. All right, there's multiple ways you can do Rule 40.
No, I know, but if you look up rule, yeah.
I think Sam's about to talk about the operating margin, which is the OG version of Rule
That's
40
what I
score.
look at. I look at the operating margin, and if it's gap, even better, like solid metric.
You have to pay for talent. You have to pay up for talent.
Yeah.
SBC is not a big deal, in my opinion.
But no, I totally get that. That's why I mostly use it for software stocks. It's very hard for me to use it with anything outside of that sector. I'm not discounting anything though, because obviously it's working for you. Right.
Well, the net income would strengthen my argument on A-Lab because they're gonna have 43% net income margins.
Okay,
so that's like the real one.
That is something that where I would take that into account when I'm using it as a comparison. Like, Rule of 40 is a great number, but like I would use that. Well, I use it mostly for comparison when it's between the same sector. So if I'm looking at like something like data stocks, I'm looking at MongoDB or Snowflake or Palantir or something, I'm not going to care about Palantir because that Rule of 40 blows out of the water. But I'm saying that's when I would use that metric. But like, it's not like this is a big Rule of 40 because of this and this is a wide moat. Like, it's man, I know you know this. I know you know this.
Yeah, you're right.
I know you know this. Like you've proven you know it. I'm not trying to. I'm saying what works for me, but totally get it though. Like the one reason why is because it's got the partnership with Amazon. Like that's just it. And Amazon is definitely growing the proprietary chip sector and the amount of money they're able to sell to these clients because they don't want to buy the NVIDIA for like smaller workloads. So like that's just I don't know. But before we oh sorry, go ahead.
No, you go.
Well, I was gonna say I wanted to shoot it over to Amp because I know he's definitely got something to say right now.
Well, I'll tell you what, this conversation's fantastic. This little debate here after that deep dive into Adtech it's fantastic. I hate that we're pulling back from that, but I do want to give a special shout out to our sponsor over at Osprey Funds. If you're a fan of crypto and you're looking for ways to add it maybe to your IRA or your brokerage account, they create products just for you. Of course, we do say these things just to put them on your radar so that you can check them out. Would definitely direct you to their website, ospreyfunds.io. Do some research and due diligence over there. They did create a Solana trust, which trades under the ticker OSOL. It's the first Solana ticker or instrument that has come to the market. So it's very interesting. They also filed, they're a sister company of RecShares, who we also do a lot of work with. They filed for a whole lot of things. I know you guys saw the Trump meme coin craze over this weekend, and they actually filed for an ETF for that, for Sol, for XRP, Doge. We'll see if any of those work out. It'll be very interesting, but this isn't a recommendation, of course. Make sure you do your due diligence and check out the prospectus on their website. But we do appreciate them for sponsoring this show. And I'm excited to hear if you guys have any comments on this, Trump token, the craziness there. And then, of course, I know there's a lot of AI stuff you guys are going to get into.
Well, I wanted to close off because Shay, go ahead. You're going to say.
I was going to say Logical. I had no idea about that ETF.
I
was like, what?
Wait, a Trump coin ETF? That is like
the filing. Yeah, the filing came through. It's Trump, ETH, Bitcoin, Sol, XRP, Bonk, and Doge.
Oh my goodness.
Who knows?
No.
Who knows if these get approved, right? These are just filings on the ETF, but it's public information. We saw
everybody
that
do your research. Do your due diligence. Not financial advice.
Not financial advice, of course.
These are very high-risk products for sure.
Yeah, of course. And so they filed for those. Those are not there yet. I just thought that was interesting to throw in there. But of course, they do have the Solana and Binance Coin one that is trading live right now. Please do your due diligence on those. But yeah, shout out Osprey Funds, and let's see what you guys have next for us tonight.
Yeah, it's funny though, because when we're talking about this, obviously Trump has come out pretty pro crypto, and I saw there was an executive order that dropped today around digital assets. I didn't get to read it, but I saw that, since Gary Gensler's last day was Friday before the inauguration, I heard that a lot of these ETF filings were hitting the SEC desk as he was before he could even leave the office. So I mean, people are obviously pretty excited about crypto, digital assets, that industry. Probably Coinbase is going to be a company that's going to be a beneficiary of that. I mean, they're already doing the Bitcoin ETF custody. So we'll see. We'll see how this space evolves. I have very minimal exposure to crypto in general, but yeah, I mean, it's crazy time for sure with the president of America launching his own meme coin and his wife also doing the same. I got absolutely bagged on the Melania coin. I do gamble these things from time to time. I love trading shit coins. I'm sorry, I'm gonna say it. It's fun for me, and I made a killing doing them, especially in last year. So batter's got to swing. Trump coin hopefully bail me out of my position, but these are just gambles for me. It's fun money and nothing too serious, but I like to follow along, but clearly feels like we're in like a simulation right now. You guys have any thoughts on that?
I own Trump coin just because I'm not a crypto First off, that could be the top sign of crypto for someone like me.
Could be.
I bought $500 worth of Trump coin at $40. It's at $32. I think I added like another 200 today.
Oh my god!
I really think that sometime in the Trump presidency, it's gonna hit $100. I really do think so. It's just
not financial advice. We're gambling.
Not financial advice.
We're gambling.
Also, I bought some Trump coin.
Did you actually?
It's FU money.
All three of you bought this, but y'all all three were very quiet about this, and all thry of you actually own it and trade it.
Yeah.
Well, no, I don't trade it.
It's just it's more entertainment. Like honestly, it's a dinner.
Yeah.
It's I have $600 in it. It's like Logical's dinner that he takes his wife. It's like not a big deal.
I want to transition the convo a little bit. We got some interesting stuff from the Pelosi tracker. She files her trades every once in a while, and we saw that she had taken pretty big call positions in NVIDIA, Google, the usual suspects. I think it was VRT. Is that one of them? Or
was it Vert? I thought it was
just VST. Vista, maybe. Yeah, you might be right on that.
VST. Yeah, you're right.
The one interesting one to today that was filed was a very small company, because these are all like, hundreds of billions, $1 trillion companies.
Yeah, they're pretty big
And she
companies.
had a Tempus AI, ticker TM, which thankfully I was already long this stock because I had done quite a bit of research on AI and healthcare. And, we talk about the next order beneficiaries of AI, and we think that, it makes sense that some of these companies that have access to tons of healthcare data, they have probably one of the biggest databases. They're going to set to benefit because in reality, all these models, these AI models, are more or less becoming commoditized. We're seeing, Anthropic has their own LLM, Facebook with their Llama, you have Google has one, etc. So, it's not so much about the model, the AI model that's going to process the data at this point. It's more about the data that you have that you're running the models on. And so Tempus is really leading in that. And I mean, the stock has seen quite the pop. It's up like, I don't know, 75% in the last few trading days. So clearly the Pelosi effect is alive and well. But yeah, I mean, the company itself has a lot of long-term prospects. What's really interesting about that setup that I really liked was that, I mean, here's a couple things. We had the IPO lockup. So this company went public in June, and in December, it was set to have its lockup expiration. So short sellers knew that, and they basically shorted this stock ahead of that IPO lockup. And then you got the second order of selling from the insiders. And then you had a third order of selling in late December from people who were probably taking tax loss selling. And so you had triple selling activity for a company that's basically putting up over 30% growth for the next year, heading towards profitability, has this really big advantage in a very big tailwind industry. So the setup looked really good to me. And then the cherry on top was Pelosi had filed she bought call options. She's a degen. I love that. Thank you so much, Miss Pelosi.
So let us know when Pelosi calls you for stock tips, so that way we can get in on it, because it's clear.
She follows me on Twitter, man.
That I don't think she follows you on Twitter. I think she's got your phone number. She hits you up. She's like, "What should I buy next? Logical." She calls you Logical. What should I buy next? Logical.
Yeah. You guys have any thoughts on this?
Yeah. So first off, you introduced Tempus. I've followed it a little before you introduced it to me, Logical, and that was also before the goats invested in it. What held me back before I'll say what held me back. What got me intrigued about Tempus was you went about this earlier, where the quality of data is going to be vital in the next couple years, next decade, because LLMs will become a commodity, and at it's a race to the bottom. Eventually, there are going to be so many LLMs everywhere that in order to tell the difference between all of them, it's all purely based on the quality of data that's fed into them. So that's why Reddit's doing a great job in the past year, because they have the best quality of data. Like, there's no BSing on their platforms. There's no ads. Like, if you're an entertainment company, for example, and you want to see what's the sentiment on an IP or a trailer, like, you're going to be using Reddit's data because that's the highest quality. You can actually get a good sentiment read. So the sentiment read being fed into these LLMs is a premium, in my opinion. And that's why Reddit's doing so well. Tempus AI is the same thing, where they have, don't quote me on this, but I think it's like 2,000 to 3,000 institutions that they partner up already. So they have like millions of real-time data from patients that they have in these institutions. So they're I'm blanking on the word. Is there an intelligent diagnostic platform? I think that's what it's called, which essentially uses the Gen AI to synthesize these data sets and actually generate actual insights. What does that sound like? Freaking Palantir. That's what Palantir does. This I don't know if this is gonna be the Palantir of AI, but they have a lot of similar traits of like what Palantir is tackling on all these industries they're doing, government, industrial, etc. There is a world where Tempus AI could do this for all these institutions they're partnering up with. And it's like, I'm bullish on genomics. This is a really interesting angle on genomics because it's one of the product lines. I'm interested in data, huge data thematic. That's one of the product lines. And AI applications. That's one of the product lines. Like, they check the box on everything. That's why I'm so bullish on them like thematic wise, and like ethos wise, their fundamentals, that's what kind of catches me like, because I'm looking at it right now. They're supposed to be growing 39% this year in 2025, negative margins across the board. They're supposed to be, it's going from 39% to 22% CAGR for the next 3 years. Big dip. Margins aren't really expanding that much. 2028, it's supposed to finish 12% net income margins at 22% top line growth.
Shai, let me pause you there.
Yeah.
If I listen to these forecasts, that's exactly why I missed out on App 11. I don't think you should take them too like strongly because anything can change tomorrow. A lot of these AI and healthcare, I mean, like you get Larry Ellison with comments tomorrow. You get all these like open AI projects, starting to really push, I don't know, all that stuff. So anything can change overnight. And what I would say is that a big part of the advancement of the revenues and the scaling of revenues will come from, I don't know, if these tests that they're doing and they're partnering with end up getting insurance reimbursement or something like that. So the thing is that like this thing can change overnight. And so a lot of these forecasts are based on what the environment is today. But, we don't know what the environment will look like tomorrow is all I would say.
No, you're absolutely accurate, but I think the fundamentals is what didn't take me over the finish line of like starting a position. I was like, I'm going to monitor and see what happens. Clearly, if Nancy gets involved in the stock, like
she might know a little something.
That some kind of government related initiative is going to be flowing towards Tempus that they're going to capitalize on, and that 22% growth I was talking about the next couple of years, it could be an App 11 situation where it grows to 40%.
I saw somebody
that's a game changer.
I saw somebody on Twitter put a $2,000 price target on this thing with a long thread explaining why. I mean, that's just absurd. His stock is trading around $53. Obviously that seems absurd, but my point is you never really know what's going to happen.
You own a 25x? What are you talking about? I'll give you a guide path for 25x on Palantir. It's going to be $5,000.
I know you focus on rule of 40 and like the margins, and that's really big for you. But I mean, when I see a company that I can see a clear path towards profitability, I might give the profitability a backseat, knowing that they have cash on the balance sheet to make it there. I know that they're scaling their revenues, so their margins are going to get less and less negative towards zero and profitability at some point. I mean, when it was trading around like $30, it was trading at like 5 times next 12 month sales for a company that's growing 30% on the top line. I mean, honestly, that seemed to me like it should have been worth maybe closer to 60, if I'm being totally honest. I mean, whether or not that's true, just given like the longevity of their growth, and clearly re-rated a lot faster than I thought. So I've been trimming into this strength, but let's see what happens. I mean, it's a big tailwind.
Sorry, I will say, like, when it catches before I pass it to Sam, when it catches a major bid like it did 75% on a narrative, it's not really anything to change.
100%.
It's going to disappoint in earnings potentially. So like, that's why I'm being somewhat patient. We're like, nothing really changed fundamentally in the next like couple weeks. So like when they report their earnings, their stock essentially doubled, but it theoretically got 2 times more expensive than it was before on no fundamentally driven reason except for.
Last thing I want to rebuttal on that is, again, I explained that they had a triple selling situation with IPO lockups and the tax loss harvesting where people are very price insensitive. So it should have probably never traded back down towards that $30 level.
Well, they're not idiots, but they know the business inside out. They know like it's a tough like industry to tackle. It takes a lot of years. So like that's like, even though she's really bullish on this name, I think specifically for Tempus, it won't be as explosive as like her investing in Broadcom, NVIDIA, these kind of names who have themes that they're benefiting right away and velocity.
Like 50% ago.
That's what I'm saying. But that was 2 years ago, though. That wasn't even that long ago. Like Broadcom had an insane run the past 2 years.
That was like a quarter ago.
Was it a quarter ago? I mean,
it was
IT
like
infrastructure is insane right now.
Yeah, no, she brought Broadcom. And when she does those plays, that's when I don't really take it as if like, okay, she knows something, because like these it was already close to $1 trillion company, so I wouldn't have expected it to be like, oh, Pelosi, she was just another whale that got in. Like,
dude, a $5 billion company, that's pretty much out of her.
Yeah, no, that's what I'm saying. That's what it's like. Hold up. So like, this is a pretty good trade.
Do you think it's sus that she probably has some anecdotal evidence like this happened after she?
What? Pelosi?
Rewind. After she 3, 2, 1, rewind. After she messed up her hip, she like witnessed something that was like maybe the platform being providing precision medicine for her, or like she's like, whoa, what is this? It's Tempus AI, and that's why she got bullish. So it really wasn't government related; it was anecdotal evidence, and that's like a little worrisome.
3 words. Pelosi don't miss. All right. So she puts her money on something, it's gonna win. Okay, it's gonna win. No, but to be honest, yeah, I mean, it's very, for me, it's speculative. Might not be for you guys, but it's just
no.
it's just
I'm getting in. I'm getting in at $45. I'm just waiting for it to go back to
Man,
that.
I got to 47 today. You had your chance, and
I was watching that. I'm so annoyed. I had my limit on there,
right.
but 45 is their anchored average VWAP from their IPO, and it's also their 21-week EMA. Identical. I think that's a great level to add.
I did want to say real quick, because we're talking about Tempus AI, there is that second order effect candidate in my view, because I think we're getting this really big narrative about like data, AI, cancer detection tests and stuff. There's a small company, I've talked about it with you guys, and I think Shai, you mentioned in your morning show today, PSNL, that's a ticker for Personalis. They have their cancer detection tests. It's a small company, like 500 million market cap, has about $185 million in cash as of their preliminary fourth quarter report. They're doing $85 million in revenue a year. So really I would say that the valuation isn't all that stretched. Tempus AI actually owns 18% of that company. They've continuously acquiring more shares in that company. They bought it as high as $5.06, I believe, and stocks, right around $6 right now. And recently they got an investment of $50 million from Merck. I think a lot of this probably comes down to, do these cancer detection tests, they have very high sensitivity. Do they end up getting insurance reimbursement? Because that's going to end up scaling them. And so I think that's what it comes down to. That really takes these companies to the next level and, becomes more standard care and stuff like that. But yeah, I mean, for example, their breast cancer test is able to detect breast cancer 15 months before imaging is. So clearly there's a lot of value here. They had really good data on their lung cancer tests as well. And, they're not, Tempus AI doesn't just have a stake in that company. They really feel like they're partnered with this company. I think they give up to like 200 telemarketers or something like that they help distribute the Personalis test by calling different physicians' offices and getting them on board with the product. So they're really invested in making that company do well. I'm not really pitching the stock. I am long the stock, a small position, spec position, obviously. But I just wanted to say, maybe it is time for these names to really, the AI and healthcare kind of thing to take off.
Do you feel like it's duplicative if you own Tempus and PSNL?
I kind of like the split position in this. It's like kind of a barbell approach of like having a little bit of both. I think that they're both going to work, but instead of having like a full Tempus position, I can kind of hedge that against and having like a smaller, more spec, higher upside kind of play. If you guys pay attention to a company called GeneDx Holdings, ticker WGS, that thing went up 30.
By the way, for all the OG listeners for Pounding the Table, it's Semaphore. They rebranded. It's
I didn't know that Semaphore. I had no idea.
Yeah, they rebranded it. Yeah.
Oh my goodness, Semaphore was a great. Oh man, that was a great company. I think there was another company that they took public too, that same SPAC, and that one ended up not being so great. So tough one, tough business. But anyways, I was gonna say that company 30x'd, and what they do is they have tests for rare disease testing. So I mean, you're talking about now, Personalis is a cancer detection test, obviously a much larger TAM. So, if a company like that could get traction like that, I mean, it's worth taking a shot with a small percentage of the portfolio. And again, the narrative, the theme, the valuation isn't bad. I don't know. Go on.
Well, I know why Sam's not gonna like PSNL, but Sam, I want you to tell me why I think you won't like this name.
Oh, I thought you were going to say the name. Okay.
No. PSNL. What Logical's talking about, the stock. I'm looking at them. There's one reason I know you're not gonna like this name, and you mentioned it on this call. Can you guess what it is? Why?
Oh, can I guess what it is?
Yeah.
Dude, I don't know. Go ahead.
25% gross margins, 30% gross margins. It's a tough product. By the way, it's not a PSNL issue. It's that whole industry like that. What they're trying to tackle. It's not going to be high margin. It's just not. But
no, I kind of expect that in this industry. However,
let's see what GDX is actually. Let's see what
I'm not a huge biotech. I know this is
biotech,
but I'm not huge in this. It's a too hard to know pile for me.
What are you gonna say,
All
Shaq?
right, that's wild. So I don't know what the terminal rate for is PSNL, but Gene DX went from 5% gross margin, 46% gross margin. Now they're at 63% gross margin, expanded to 66.
I mean,
That's wild. I didn't think they could do that.
isn't that just because of a scale issue? Like once you get that once you get insurance, then you get the reimbursement, then you get the scale that more people will be using these tests. I mean, look, they had I'm looking at the third quarter results, 41% year over year revenue increase, but it was a 96% growth in the biopharma business segment.
Oh, so yeah, it's just
That's it's gonna get there. It's just gonna take time, and it's kind of being masked by the overall numbers of what's been going on at the company. So we'll see. But yeah, I mean, look,
Well-
I would just say, sorry, one last thought, because we're talking so much about biotech and stuff like that. Like, dude, biotech has been beaten up. It's been left for dead. I mean, go look at XBI. It can't catch a bid. But I think that there is a lot of great companies. And for the last 2-3 years, I mean, you keep seeing these charts of like record number of biotech stocks trading below cash on the balance sheet. I mean, I own at least one of those companies that are trading at half. Their market cap is like half the amount of the cash on their balance sheet. So there's a lot of value in biotech if you're willing to go look for it. Sorry, go on.
No, I agree. No, it's one of those industries that were vulnerable to high interest rates. Like they're high quality laggards out there. But Sam, go on.
I mean, we're invested in software, or we have a lot of software, right? Like that's definitely interest rate sensitive. Not as much interest rate sensitive as something like this stock would do, but I look at these margins. I'm just like, I don't know. I don't know if I could invest in something like this. Like, I mean, I just don't. Maybe it's because I just don't get it, and that could very well be it.
Well, first off, you are investing in it. You own 20% PSNL because you own Tempus AI. So you're talking about that right now.
I didn't know you
own a very small position in Tempus AI. It ended up being, I bought it overnight when I saw the Nancy Pelosi thing. I was like, why isn't this thing moving more? So let me just buy it.
Oh, you're up like 20. You're like 25%. You're up then.
I'm up pretty good amount. I think I got it like around $40. It's as it was going up. But this is entertainment, dude. Like, honestly, it's such a small position. And the same thing with the Trump coin, like such a small position. It's interesting to look at, and I won't be like so bummed if it like goes back.
I can't believe you just put Tempus AI and Donald Trump coin in the same bucket.
This is the reason why
blasphemy.
This is the reason why conviction is in the eye of the investor, right? Because like you can't. You like someone could literally look at Amazon and be like, Amazon is a speculative stock, right? They're going to be gone soon. Like someone could prove that. Someone could easily.
No, I will give someone.
I don't think so, but
I will give someone $1,000 if they can do a business case.
No, I'm saying that someone can prove that to themselves that that's the case, and people be like, I don't want to touch Amazon. I'm going to go over here and buy Chevron, right? Yeah. Like somebody could be a dividend investor, be like, Amazon will never have a dividend. I would never that's just like the sort of thing. But like for me, it's like I try to look at the Tempus AI and I can't grasp. There's too many moving parts, especially in this sector. We're getting a little bit of feedback, by the way.
Oh, well, I think it's probably a good place to call this one anyway. I think we've been going for we got a lot of topics in, so let's just hand it over.
Before we hand it to the amp, there is no point of creating a what category should you talk about? Because I think we did not have Adtech even on there again. And I think like we didn't cover we had 8 topics. I think we covered 1 or 2 of them.
Dude, Logical was like, we're only going to talk about Tempus for like 2 or 3 minutes. And like, what? I was like,
I have like
it's an interesting topic though.
I got like 25% of my portfolio in like biotechs and healthcare, so I do have a little bit something to say.
You know this stuff. You know this stuff well, and that's why you're doing good, and that's why you're up 20% in the year already, because you know this, like you understand it.
There's a lot of stuff going on, and there's a lot of value in this market. You just got to go find it, man. What's working? You know what I mean?
Yeah, no, for sure, for sure.
Anyway,
I'm gonna before we hand it to Amp, I'm gonna create a poly market poll on who's gonna finish the year better. Sam, myself, Logical. On the level we're at right now. I'm only at 8%, so I'm way behind Logical.
I'm only at 7%.
I don't know what you're at, Sam. Yeah,
I'm only at 7%. So like
the odds are probably like 40%.
I'm going to cash. I'm going to cash right now. Just gonna call it a year.
Honestly, if you go to cash right now, there's a very good likelihood you're gonna beat like 90% of the hedge funds out there. Like it's just 20% up in just a few weeks is crazy. Man,
Let's see, man. By next week, it could all change. We have FOMC meeting next week. We'll probably have a lot to talk about. It'll be a fun
Well, we have
episode.
Meta, Microsoft, Tesla all in the same
Shit.
afternoon on Wednesday. It's gonna be wild.
It'll be a fun
Amazon's
one.
on Monday, dude. Amazon's on Monday.
Oh, I'm excited.
And-
Wait.
Oh, wait, no, that's a following week. That's a following week. Amazon.
Don't
Amazon
you dare! I was
commented
like,
on it.
what?
No,
I had no
that's
idea.
the following Monday, which is actually surprising. I was like, why is Amazon a freaking Monday? That was like
That was
kind of odd to see.
Boys,
Alrighty.
what a great show. You guys, like, you didn't follow a script, but it was so organic. It was a fantastic conversation. Episode 2, I loved episode 1. I think y'all outdid episode 1 with this one. This was fantastic. There was some great moments in here. Really appreciate the boys doing the podcast with us under Wolf Financial, investing with the boys. Make sure you follow the Twitter handle for that. We have the spaces that we do, as well as these podcasts that go out on the weekend. We also want to shout out Osprey Funds, our sponsor, ospreyfunds.io. Check them out. If you are interested in investing in crypto, you want to just do it in your brokerage, you don't want to deal with all the wallet stuff, give them a look. They give you the ability to purchase it right in your brokerage or IRA, not have to deal with all the on-chain, off-chain type of stuff. So check them out. We thank them for sponsoring the show. We thank the boys. Appreciate y'all. Y'all have a great, great rest of your night. I can't wait for next week's show. It's going to be a packed one with all the stuff coming up. Take care, everyone. We'll see you guys next time.